Welcome to Plan Life Right, your financial GPS through this economic demolition derby. I'm Kevin Ross, and if I had $1 for every rate hike panic, I'd have enough for a down payment on eggs.
And I'm Matt Floyd, here to ask the hard questions like if the market's this wild, do we still tip our 401k managers? Spoiler, maybe. Especially if they haven't passed out yet. That's after you figured out the embedded fees.
Yeah, that's the key. First of all, what do you think of being out here in Augusta, huh?
It's pretty nice. Not I'm in the right place.
Yeah, way better than where were you? Were you Ohio?
Butler, Ohio.
Butler, Ohio, in that cabin there. Wow. So glad to be out here. What a beautiful week, Masters Week. My favorite week of the whole year. Every year I look forward to the Masters. And again, so far it hasn't disappointed. We've got a pretty exciting leaderboard here with Justin Rose, who this time was -7 on Thursday. He finished today 1 under, so -8 for the round, leading the way. DeChambeau's right behind him. You got Scotty Scheffler pushing there. I think he's halfway through here on Friday. So we're taping this late Friday afternoon. But we wanted to kind of, with this marketplace and with it being Augusta, this is going to be some golf analogies. Hopefully Matt brings me back into, if I go too geeked out on the golf analogies, or if we get into bonds and I get too geeked out, his job is to bring me back in and try to make it so that everyone kind of understands. So let's just kick it off like day by day, because this was such a volatile week and a lot of stuff happened. This is not for the faint of heart.
Yeah.
This is what real trading.
Yeah. Trillions gained and trillions lost.
Like
all in
that.
1 week.
All in 1 week. So we'll break down. Monday was kind of like the first hole at Augusta. Kind of smooth, polite. Everyone's pretending they know what they're doing. It's pretty easy par hole. Few birdies in there, a couple bogeys because of nerves most of the time, but kind of an easy, smooth way to start the Augusta National. And that's kind of how our markets did. The S&P was up almost 0.5%. NASDAQ was up 0.7%. And then Tuesday hit like a rogue sprinkler on 12th green.
Exactly. The Fed hinted at staying hawkish, and the 10-year yield did its best SpaceX impression, straight to 4.5%.
Yeah, that's the rate sensitive stocks just got hammered. So like utilities and REITs, man, they got crushed. So in small caps, they dropped to almost 2%, 1.8. And, the proof here is that when the big boys sneeze, the little guys catch a cold. So if you're out there thinking you're on your little Robinhood app or trying to day trade this stuff, I promise you're going to lose more than you win, because as a former institutional trader, bond investor, this thing, the smart guys lose their money on this. And this week is a perfect example of institutional money getting their butts handed to them.
Well, as a former bond trader, how do you think the bond investors are doing this week?
Well, funny, we're going to get into that because I'm going to go really deep heavy there at the end. But I was talking to one of my close friends that's still in the market, and he said this is as volatile as it's ever been. And he named a couple of different cycles that we both lived through, like in the late 90s, that when most of these guys on TikTok and Instagram and that weren't even born yet are trying to give you investment advice. This is stuff that I've lived through because I'm an old guy. And my buddy, who's also an old guy, that's still in there doing it every day. We're able to pull from some of these moves and look at some of the similarities. And there's some stuff that's happened this week that we're going to talk about in this podcast that hasn't been seen before. So, or it's been a long, long time. So the bond investors, man, they were sweating more than a caddy on Sunday. I'll tell you that. And so, I kind of like to, because of Plan Life Right, Advisor Rescue, but the podcast Plan Life Right, this is kind of geared towards, the 20 and 30s. And the reason why I started this podcast was because my oldest son finally got engaged to a girl he's dated for 10 years. He's a slow play. He stayed invested, and so they're getting married, and it kind of brought me back to their age when we were a little younger when Jackie and I got married. But it was I was like, man, if I knew what I know now when I was in my 20s and in my 30s and made some changes and did some things a little differently, because of course hindsight's 2020, I would be a lot better off. Well, now that I've lived it, I'm here doing this podcast. And the other thing is the reason we're doing the podcast is because, I've held these classes in colleges, and I'm talking to pre-retirees and just retirees. And the number one thing they always say is, gosh, I wish I'd have known this 25 years ago.
Same.
So
I'm right there. I'm mid-40s, and I wish I knew this 20 years ago.
Right? They don't teach this stuff in college.
I went to college to learn this stuff, and they didn't teach it to me. I got a degree in finance.
Exactly.
Never mentioned it.
So it's one of those things that, this is a passion of mine. If I can give some knowledge and living it, I think that's a win. I told my wife about this, and she's like, I thought we were doing pretty good. And we are, but I could have done a lot more. And some of the instruments that we talk about on a day-to-day business here with Advisor Rescue weren't even available back then.
Exactly, yeah.
But we got some things now, and the math and all the smart people that figure out this stuff. It's a lot better than what was available when I was in my 20s and 30s.
Right.
So what I would say for the 20 and 30-year-olds, don't panic through this. Please don't be selling anything right now.
Yeah, keep your money in the market. The only people that are losing actual money are the ones realizing losses.
That's exactly right. So
actually, dollar cost average down.
Yeah, exactly. Oh, and if you have it and you're sitting on some cash and you've got, the risk tolerance, right. You can't come in and say, well, everybody uses buy. If you're a school teacher, for example, and I'm married to a school teacher, they're not risk takers by nature.
No.
Okay. So if I took her portfolio and I bought her 10 stocks at 25 years old, she'd have been freaking out and looking at every statement, and I'd have had to deal with that.
Yep.
So I try to hide a lot of the statements because it was volatile, but if you're not, so when I talk in generalities, I remember you've got to do a risk assessment. Everybody has high risk tolerances when the market's been going up. And so all these young TikTokers, man, they're, buy Bitcoin, buy this.
Yeah.
And then all of a sudden,
GameStop, AMC.
Yeah. All of a sudden they lose their shirt on it. They don't have that risk tolerance. Right. So you've got to be able to stomach markets like this. And I can tell you, talking with some of my friends that are on Wall Street, they're like, I hadn't seen this since 30 years. It's volatile, and the 20 somethings that my buddy was telling me, he's like, they don't even have a clue. And the young people now, they're kind of like, this will all pass. It only goes up. It does eventually. They've got longevity. So the 20 and 30s, I said, don't panic. Think of this as a financial version of Black Friday, and look at the deals in the ETFs and not the TVs. Because on Black Friday we're trying to buy the biggest TV. Yeah. Back when I was in the 20s, 30s, if you got a 32-inch tube TV, man, you were rocking.
Yeah.
And thing probably cost like $1,500 in 1990 money. So
you could pick up SPY or the 4Qs. You can pick that up basically at a discount right now with a coupon.
Yeah, actually, we're gonna talk about those the QQQ, because that thing got crushed a couple of days this
and then
week.
It got reinflated and then it got crushed.
Yeah, exactly. So if you're in your 50s and 60s, time to review your bond ladder because long duration bonds just got crushed. It's like getting trickled like a ball trickling into Ray's Creek for a double bogey because these long treasuries got wrecked. You know, somebody yesterday, on Thursday, I should say, was playing lights out through 14. He's on 15. He does this small chip, and he's really good around the green. It was a little too aggressive. It was in front of the hole, but it's the Masters, baby. And it's the fastest greens you'll ever see. And that ball rolled down past the hole, down to the end and into the water.
And still rolling.
And our buddy Rory McIlroy got crushed with a double bogey. So he was, I think, -4. Then he's now -2. Well, that gets in your head as a golfer. Even the pros, it still gets in your head. And then he gets on 17, which is a difficult green, but kind of really straightforward. And he double bogeys that because it was all in his head. That's the long treasuries. That's what happened this weekend there.
Yeah, they got wrecked. And the guy that holds the bag, they fell over their own shoelaces.
Yeah, that guy, Matt, they're called a caddy.
Oh, that was the bad guy.
Yeah. Those bad guys are called a caddy.
So do you think we should be worried right now?
Well, yeah. I'd say not yet, because I think here I would say put your seatbelt on because it's going to get crazy. And we're not done with the crazy.
So I haven't seen a chart jump this fast. Maybe when Dogecoin met Elon Musk's Twitter. Dow's up 11.3%. NASDAQ was over 12. What was in the punch bowl?
Well, that was Wednesday, right? So what happened on Wednesday? Trump hinted at a tariff pause. And so these trade sensitive stocks like Apple, Caterpillar, they soared. And so did the overall markets that you just mentioned.
Yeah.
The short squeeze got squeezed like a Florida orange. The most hated stocks, even Tesla and Coin, they went vertical like Roy McIlroy's tee shots. So for our listeners like Matt, short sellers got squeezed like toothpaste or like a Florida orange.
Yeah.
And then, the dealer gamma flip, all those algos out there, they went berserk. And those traders flipped from sell everything to YOLO, baby. You only live once. Tesla was up, 29% on Wednesday? Yeah. It's just like Justin Rose on Thursday at -7 with a 3-stroke lead over Scotty, Aberg, and Connors. Meta up 14%. Yep. Coin up 22%. So what does Wednesday mean? Well, for the under 40 crowd, this is your Super Bowl, right? This is your master. Just remember that even those meme stocks come down eventually. So
you don't want to be the one left holding the bag.
Literally,
there's a lot less millionaires than bag holders on all those meme stocks like GameStop. They're still yeah. I'm in hands. They're still holding strong. I don't know if they're going to get back.
I don't know if we'll ever see that again. So if you're over 50, man, you may be feeling a little FOMO because you were in shock over Tuesday still, and last Friday. So let me just say, put your Robinhood down.
Right.
Put that ad down. Step away.
And don't even check it.
Yeah. Don't chase these moves. You don't have like the 20s, 30s, and even you don't have longevity, unfortunately. I mean, we are living longer, but we don't have the longevity and the accumulation. Because I think that most 50-year-olds aren't thinking like a 30-year-old. The 30-year-old's like, hey, I got 30, 35 years till I retire, right?
I got plenty of time to be lucky and unlucky all in the same game.
Yeah, because I'll just weather the storm. Well, you're in your 50s, unless you're planning on working till 80, well, then you got you're going to weather it, yes. What are you going to do with all that money? I mean, right?
Who wants to work till 80 anyway?
Right, exactly. So you don't have that. Don't chase these moves. Even though you're like, oh my gosh, there's some deals out there. Again, unless your risk tolerance is off the chain and you just got money, like going to Vegas and saying, hey, I'm going to put it all on red and spin it, baby. or even if you're like really ballsy, go put a 00 green.
Yeah.
You know, that's the deal here. And this is real. So Wednesday was a crazy good day. Everybody was loving life. I mean, I was watching Fox, for example, and they're like, "Oh, see, Trump and the tariffs, he was right," and they're all shouting hallelujah. You turn it on to CNN, and they're like, "Whoa, you know this."
Trump was wrong.
It's too volatile. It's all, you know. So people don't get all jacked up on this media hype, but no matter where you lean, it's the hype is the hype, and there's no clear like Switzerland out there in the media,
Right, exactly.
right? You know, hopefully we're a little more Switzerland here on this podcast.
You know, it's not just the retirement accounts that get affected by these you call them violent.
Yeah.
It's not just those, it's college education, 529 plans. That money's directly invested in the market.
That's right.
And one of the things that will kill a 529 plan and put college off the table is a year like this right near the end. In the last 3 years, if you get a year like this, your kids aren't even going to college. I mean, that's why we say
that's right.
Go with an IUL, because you can't lose any money. It may not grow as fast, but you can still cover college, and you got that safety net built in.
That's right. You're able to borrow that tax-free money,
exactly,
right?
Yeah.
So that's a big deal. So, you know, in your 50s, it's a sequence of returns, a real deal. Right. We're going to get a little bit into that.
I have that conversation 20 times a week.
That's right. But if you're in a 529 plan, all of a sudden you now brought sequence of returns risk into
college education.
That's right.
You better start dumping more money in
education.
Buy this dip.
That's right.
And you know, if you bought the dip, congrats. If you sold at the bottom, I've got hugs and tissues. But is this sustainable? I mean, could we see this wild swing of the pendulum? Could we see this every day for the next year? I mean, is this even possible?
Yeah, it's like a 350-yard drive into the wind. I mean, there's only a few golfers that could do it. Brian DeChambeau, Rory McIlroy comes to mind.
John Daly
back in the day when he could crush it like that. He's old. He's got a beer belly out there. I don't know if he could do it. But so the answer to that question is no. But it tells us that the sentiment's shifted. We're going to be in this volatility out here. You're going to see some wins, you're going to see some losses, and it's going to be really violent out there.
Well, I mean,
not for the faint of heart.
That was Wednesday.
Right.
Thursday came in like a toddler crashing from a sugar high. I don't know if you remember those days with yours. My kids, they're not toddlers anymore, but they used to be just shortly ago. S&P down 2%. The NASDAQ was down 3%. Explain it to us like we're that toddler coming down on a sugar high. Explain to me like I'm 5.
All right, kiddo. So when everyone gets excited and buys everything, prices go up. Right. Then reality hits, which is profit taking and options expiring, and bam, everybody runs for the exits.
Yeah. It's like a run on the bank
all at once.
Stock market.
Exactly. All at once here.
So I don't think that a 5-year-old understood what that means. What is profit taking? What is a run on a bank? I mean, I worked for one of the biggest banks in the world. We profited from other banks having runs on them. But most investors don't understand that outside of watching It's a Wonderful Life.
Yeah, right. Well, I think that it's kind of like you've got to
bought in low and now it's super high and now they're getting scared. They're like, well, I'm just going to go ahead and sell my stock now because I'm up. And folks that bought last week, they just lost a ton of value in their accounts. They haven't lost money yet. They've lost value. And there's a big difference between losing value and actually losing some of your investment, right?
Yeah. Okay. Yeah, exactly.
So, I mean, NVIDIA, they were a star. I mean, as you know, they're going to replace Netflix and the manga stocks that are in every mutual fund eventually, probably. But everybody was in love with NVIDIA about this week.
So NVIDIA on Thursday, I think it gave up 5%, lost 5%. Advanced Micro Devices,
all the tech stocks.
Down 7%. ARC down 4%. So, what do you do in a day like this? You're in your 30s somethings. Just keep your cool. Maybe you do a little rebalance. I wouldn't sell anything if you got some cash and maybe you're buying the dip again. Don't go all in because it's going to be like this back and forth. This end isn't going to happen. And we'll get into that a little bit later.
Or maybe even go back to, the first piece of investment advice I ever got from anybody that owns stock was said, if you're going to go buy stock in something, buy a company you use and that you believe in. If you wear Nike shoes, buy Nike. If you own a Tesla, buy Tesla.
Yeah. So that's a great point. A buddy of mine was on the phone. We talk about every 60 days probably. We went to college together, and he came to me. He just got married. This was probably back in 1990, and he's like, "Man, my wife just got this $4,000 from her parents. They bought like one of those Gerber things that matures at 18, 19,
Gerber,
whatever.
Gerber Juvenile Life.
Yeah, exactly. Gerber Juvenile Life. And so it was $4,000. He's like, what do I do? And I said, here's my recommendation. Go buy something that you go to all the time, that you're in it and you believe in it. And you're putting your money because you've got to be there.
Yeah.
So he went and he bought Home Depot. And he just reminded me of this story yesterday. And he goes, hey, you know what it's worth right now? And I was like, no, I hadn't even looked at it. He goes, it's worth like about $400,000 now. So from 1990, this was in April of 1990 that he and I sat down. I was in Dallas for my brother-in-law's wedding. And so we got together. He went and bought it, and he put all in Home Depot. And I always recommend that, but it was only $4,000.
Yeah, I've done that, and it's never worked out.
Yeah, exactly. and he's like, man, I tell everybody about that advice, and I'm like, what if you love Sears or Kmart? That didn't work out so well.
That didn't work out so well.
All right, but the thing is you do have longevity. You got to stay diversified. Yeah. So
if you eat Chipotle, buy Chipotle.
Yeah.
If you shop at Home Depot, don't buy Lowe's. Buy Home Depot.
Yeah, but
or hedge your bet and buy Lowe's.
but look at some of these restaurants that have been around forever. I mean, Hooters is claiming bankruptcy.
Yeah.
And I guarantee you in your 20s, well, even now, because I know you still love Hooters. Yep. But when you're in your 20s, you really loved Hooters. and who would have thought Hooters would be filing bankruptcy? So my recommendation would be just go buy the S&P 500.
Yeah.
Now you're diversified. And those S&P 500 stocks, they change all the time too. I mean, your Apple, your Microsoft, your Google, these guys, they weren't always S&P 500s.
Right.
Some of those S&P 500s are not in that were carrying us through the 90s and the 2000s, early 2000s. They're not there anymore. Yeah. So this does change, but you've got longevity on your side. So that would be my just diversify.
Right. What about the folks the folks that don't have longevity on this side, the ones that are already halfway through the back nine. What do they do?
Yeah, I feel like those 60 somethings, it's like my backswing, now. It's slow, it's not really smooth, it's not always in control. The ball's gonna go left most of the time. I like to call it a drive. My sons call it a god-awful hook. So a lot of times I'm punching out of the woods.
Yeah,
so
you're staying sideways in the tee box.
Yeah, exactly. I'm aiming towards the right of the trees and get it into the middle of the fairway. So now might not be the time to take a lesson. My recommendation is go get a plan. Maybe you trim some of those big winners that you've got that's in there. But you gotta get a plan. You gotta be able to address the sequence of return risk, because it all goes back to the sequence of return. This thing's real, and if you don't understand it, it can be like getting mugged in a sanctuary city with no compassion for the victim. And we've seen that through the prior administration. Now I think that's getting cleaned up here.
Yeah, thank God.
Yeah, but for us golfers, so you might not get this, but for us golfers out there that listen, it's like hitting that best chip shot and then watching it roll off 15 and into the water for a double bogey and all but put you out of a chance to win the Masters, Roy. However, I just checked the leaderboard. Rory is roaring back. If there's one person out there that could probably get mentally focused in there and stop and go, that was just a mistake. I can come back through this. I believe in my game. So he's a risk taker. He's not the school teacher we were talking about. This guy, he's not melting from it. He's gone out there and shown that he can do it again, although he hasn't finished his round. He hasn't played 15 yet, the last I checked. So,
but also he's a professional. He is the cream of the crop of people that do this. And most of the folks that are watching our podcast, they're retail investors. You are not professional investors. You don't have decades of experience of doing it.
That's
60 hours a week. So it is an insurmountable task if you've lost a ton of money to try to that you're going to gamble and get it right here at the tail end of your investing career.
Yeah, I had another buddy that I talked with yesterday. When the markets get volatile, I've got people reaching out to me, or I'm reaching out to some of my friends that are still into the day-to-day of the Wall Street grind. And one of my really good friends that can handle the risk because he's in the market. He's a trader. But he lost 500,000 personal wealth. So if he was planning on retiring in 2 years, that's a real thing. The guy's got the stomach for it because he does it every day. But that's $500,000 that he had earmarked for, hey, I'm going to, do a spin down. We were talking about some things to do so he doesn't have, if he's got longevity on his side, then, and all of us do because of the technologies out there. It's a real risk out there. So,
$500,000, I don't care who you are. That hurts.
Yeah.
Maybe Elon Musk, Jeff Bezos, maybe they could tolerate losing $500,000 because they make about $300,000 a minute.
Exactly.
Maybe they could tolerate that, but I don't even know this guy. And my heart goes out to him.
Yeah.
But, if you're an advisor and you follow the big, RIA that's out there that says we don't make money unless you do, I got solutions. And if you're telling your 6-year-olds to hang in there because the market's going to come back, it took a while to come back in previous downturns, and this one seems to be unprecedented. At least the volatility is.
Yes, for sure.
It's nothing. Last time I saw something like this, 07, 08. And that was unprecedented even for back then. But they need to see one of our advisor classes. If you're out there telling folks, 60-year-olds, hey, you got time to make this back up, send them to one of our advisors classes to say you don't have time. You need to lock this in and move your money into something safe. So here's my personal invitation. Give me a call. I'll make you look great and put your clients at ease.
Matt, wow, that's a nice call to action right there. I like that. I can tell you that most RIAs will scoff at that until their client is leaving them because they went to one of these retirement classes that we train our advisors to, that we teach. And then they're like, my advisor just told me to hang in there.
Yeah.
And you got the markets losing on all facets.
Yeah.
So this is a wake up call. Call Matt.
Our guys that do these workshops, they're barely advisors. They are poachers.
Yeah.
They will pull your entire client roster right out from under you because
they know how.
They know how.
We teach them how to measure the risk in the client's portfolio. I think you're talking to a guy today and said, we had a client we're working on and they had a risk tolerance of like 48 or something, which is still high for a 60 something, but their portfolio was in the 80s, right? So because they were listening to this other advisor, the other advisor never told them about sequence of return risk. They didn't even know what that meant. And then it became real. So they meet with our guy and it's like, wait a minute, and so those are the things that
the S&P's risk profile is like 74 or something, right? 72.
That's right.
That's a 500 stock portfolio that's diversified. and its risk is in the 70s.
That-
And you got clients out there
100%.
with risks in the 80s and 90s sometimes.
So
But if you're about to retire, your risk number should be
so
50
Matt,
or lower.
if maybe you're an RA and this market's humbled you a little bit, what's the number? What number you want them to call? Get a hold of
You know what? Call me directly at my desk. If you can pin me down, if I'm not in Kevin's office bugging him, my direct line is 813-736-1940. Call me. I'll explain how we do it. I'll explain how our poachers pull assets under management from RIAs. They're able to move money into safe alternatives, and then they got all those assets they can still manage.
That's
and
right.
if they got more than 10 years and you're a decent RIA, you're going to make up whatever you pulled out to put into something
There you
safe, like
go.
into an annuity or into an IUL or something like that.
You-
If you're pulling money into that and you're a good RIA, you're going to make that back for your client, and they're going to love you. They're going to name all their grandkids after you.
That's right. You solve for the gap, and that's what we
Solve for the
teach.
gap. Yep.
We teach your advisors how to solve for the gap.
I'm afraid to ask, but what about the U.S. Treasury market?
Yeah.
I mean, do I
Should
want to
be.
know?
Well, should be afraid because you know how I geek out on that because I was a former trader, bond trader. So, Matt, I just asked that if I start going down one of my deep ends, and when I told you, what this podcast was going to kind of go, I think I really geeked out, and I got in the global risk tolerance in there, and, and I just looked at your eyes,
your slide rule again.
Yeah, you're like, I'm like, okay, so let me just talk a little bit about it. I'll try to keep this, at the 30,000 foot level. So what typically happens when we see volatility in the market, meaning the stocks are whipsawing, they're up and down, we see what's called a flight to quality, and that's when the institution money is moving out of the stock market and they're putting it into the bond market.
Right.
And so that means that yields in the bonds go down, right? Prices go up. So
they're inversely related.
Exactly right. And everybody gets that wrong. But again, so if people like the bonds, they start buying the bonds, there's less bonds, okay? So the prices go up.
Scarcity.
That's right. There's scarcity in there. So that's exactly what happened, this week in the treasury markets. Yields were headed towards their biggest weekly increase. Let me ask you this, do you think it was, you want to take a guess, was it 3 years, 20 years? What's your guess in here?
I'll go with 20 because you give me that option.
Yeah. Since 1981.
Oh God.
The 10-year moved over 50 basis points. The 30-year treasury yield sold off as well. It almost gave up a point. This thing was swinging, like the 30-year moves like 4 to maybe 8 basis points. So an eighth to quarter point a day. That's a volatile market. But it moved 25. 28 points. This thing was whipsawing around there. That's as volatile as it's been since the late 90s when we had some of this stuff going on globally there.
And we're not talking about single stock volatility or single sector volatility, like where tech's getting hammered on Monday and it comes back Tuesday, then it's hammered again on Wednesday. We're talking about volatility that's all the way across the market.
That's exactly right.
Bonds are volatile. Food stocks are volatile. The necessities, Clorox. When Clorox is whipsawing, something's wrong because everybody needs bleach.
Your utilities are getting slammed all over the place. So some of your typical
stocks, shipping stocks.
Your safe havens have been getting really beaten up here.
So what does that mean for the regular investor? I talk to advisors all the time. They tell me they move their clients into bonds for safety, but if I'm understanding you, they lost money in that trade, even if, like this one RIA that told me he always moves his clients out of stocks and into bonds once the fixed rates go up.
So he's always telling you, like, his clients never move money. Because he's got this little algorithm he uses.
He's got his special sauce that every RIA's got.
He's the smartest guy in the world. And of course he thinks that. And then this happens. So Matt, here's what I think you should call that guy and offer him a solution for his clients, or you'll have the advisor down the road steal his clients.
That's right.
Because if he's doing that, you said it earlier, those clients are like, oh my God, I thought I was supposed to be in safety. I thought I was in these bonds, right? And I'm losing there. Where do I go? And they did one of ours, and then we looked at the risk tolerance of their portfolio, and it's like your risk tolerance is down here and your exposure is up here. You got to mitigate some of that risk.
Right.
Do you take all the risk off the table? No.
Risk is reward. You want to have a reward, you got to have a little bit of risk.
Exactly.
Right? But I mean, there's probably an RIA out there that had multiple clients lose at least 20% of their retirement this week alone.
That's right.
I know of a product. If they got 10 years left to retire, I know of a product they could move that money to, puts 20% right on top.
Yeah.
First day, it starts earning interest with that 20% back in there.
It's got a guarantee too, right?
Yeah, and it's indirectly invested in the market, so you can still get the S&P gains without having to have your money in the S&P or
right.
owning individual stocks.
That's
and
right.
That's where most RIAs, they're scared. They're scared to pull the trigger. I don't want to lose control of the money.
That's right.
If I pull $500,000 out and put it over here, then I'm not controlling that anymore. But you've taken retirement income.
You solve for it.
You solve for it. There's no longer a problem. Now your problem is, how do I take what's left and multiply that?
That's right.
The rule of 72. Do I have enough time for that?
That's right.
And if you're decent, you don't even have to be good. You can just be decent.
Yeah.
And you can do that.
Imagine if
you solve for your clients.
Imagine if you're one of those RAs right now and you're pulling out income, and all of a sudden you got this crazy stuff, and they were living by the 4% rule. Oh my God, it just blew up right in their face. The client's going to run out of money. Yeah, what are they going to do?
The 4% rule, 60% of the time, it works none of the time. Right?
Yeah. So it's kind of like, I always use this when I teach the class. It's like, imagine you get in the airplane. It's like, thank you for flying Kevin's airline here. We've got a 60% chance of getting to the destination. That means there's a 40% chance we're not.
Yeah.
Are you going to stay on my airline? No, but yet these advisors are telling you, oh, we're going to live by the 4% rule. All these TikTokers out there, 4% is like a magic. They don't have the experience because they've never seen this market. Well, I mean, maybe saw a little bit in 22 or 21 where we got a little bit of volatility, but came right back.
Well, they got famous for meme stocks. Let's be real. And those were volatile stocks. They were maybe 2 handfuls of stocks they got to play in the meme game.
Right.
And that's where, I mean, some of these people, let's call it, they got lucky. They took $1,000 and put it in there and it shot up 400%. And now they're looking like Einstein, but they just got lucky.
That's right.
And they're handing out advice they're probably not qualified to hand out, to be honest with you.
That's right.
I mean, I know a lot of RIAs aren't even qualified to hand out the advice they're given, especially if they're saying you can live on 4% of your portfolio for the rest.
But there's a big,
not this week,
big people. That's right. So you got a lot of people that are in their late 40s and 50s. They go into targeted funds, right?
Yeah, the 2055 fund.
So you're in your 401, you go to your 401k. You're like, oh, I'm 45 years old. I'm going to go into this target. And it's like, okay. And then when you're getting closer to that retirement age of 60, 65, it starts moving it more. It's rebalancing and it's going from stocks to bonds. Well, all of them got hammered this week. So if that's your deal and you're in the late 50s or early 60s, again, sequence of return risk, you got hammered in those targeted funds.
Yeah, and if you're a retail investor and you're watching this, or you have an advisor, ask them about alternatives to stocks and bonds. Say, what is the alternative to stocks and bonds? Is there a way that I can put my money to work for me in the market where there is no downside? Like we always say, there's got to be a risk to get the reward. But there are ways that you can get rewards without risking it. Yeah. And if your advisor says there's nothing like that, you need to get a new advisor.
Yeah.
Call me. I'll tell you who's the best advisor in your town because it probably works for us.
Yeah.
So what about this other advisor? He told me he moves his clients into high yield bonds to get them more income. Does that work?
Those things got slammed more than anything because they're tied to the U.S. Treasury. They're high yield bonds because they're a debt risk, meaning that there's a probability, a pretty good probability that they're not going to make their bond payments. It's kind of like the subprime mortgages back in. They're risky.
Yeah, and high yield comes from the high risk.
The high risk, that's right. And
risk
so
and reward.
putting it in that, what's going to happen now? You got You got the U.S. Treasury making the biggest interest run since 1981 in 1 week. That really kills those high yield bonds. They're getting slammed worse than any of the others.
And so they're not able to make their payments on the debt that they've issued.
Just like a subprime that
Back in
crashed
08,
the financial 08.
Yeah.
Exactly right.
That's right. So, that's when I got my degree in finance. Was in 08. I graduated in 08.
Yeah.
And I had a degree in finance when 50,000 financial professionals from Wall Street
hit the market. Yeah, there's all of a sudden a glut in the market there.
Yeah, thank God I was already at JP Morgan because they were helping me on the tuition assistance there. But thank God I was already there because I don't think I would have got a job
for
at
sure.
a bank. Probably not for a good 2 years.
Yeah, yeah. So to your point, a little early, if you're in the back end of your career and your advisor's recommending that you go into one of these high yields, find a new advisor.
Yeah, find a new advisor. Yeah, ask them about safe alternatives to investing. And if they say there are none, and we could spend 50 podcasts on single products,
right,
where there is a 0% floor, so your principal's never at risk. We got some with movable floors. It's like kind of like a stop loss, where you could have enacted that lower floor, moved it up to 5% in February. Market came crashing down. It stopped you at 5. You just locked in 5% gains.
That's right.
And there's an annual reset next year.
That's
so
right.
we'll see what that looks like.
If it closes lower, you get to start at the new lower. You don't have to make.
And if you don't have one of those products, get one right now.
Yeah.
We may not be at the bottom, but it doesn't have much further to go before we bounce and start coming back up. And your annual point to point is going to look like this.
Well, you hope you know that.
Yeah. Well, I hope so. Yeah. We can only hope. A lot
of the smart people they're not sure where this bottom is. I will tell you that with these tariffs and everything that's causing it, there is a lot of volatility that's still out there. And one of the things that's causing the treasuries to sell off is because, China used to buy not all, but a lot of the U.S. treasuries at auction, because that was their gold standard. The U.S. Treasury is their gold standard for China. Well, they're like, F you, Trump, U.S. Yeah. They started selling off their U.S. Treasury positions and then buying for 1.5% lower, buying the German bond and stuff. So they're cutting off their nose to spite their face, right? Yeah. But it is affecting not only. It's not just us in China. This could really send us into a global recession.
Right.
Because
China's losing money on purpose just to prove a point right now.
Exactly.
I mean, I guess they got it to lose.
I don't know. They're borderline recession now. So there's going to be some pressure on is it Ping that's running China right now. So we'll see. We'll see where that lands us here.
Yeah. But I mean, like I was saying earlier, there are solutions that guarantee a roll-up rate 7%, 8.5%.
Right.
And that's guaranteed. And then it has an income rider that's attached to it that says the client cannot outlive their income ever.
Right.
They can live to 160 years old and be one of those old people on Social Security that Elon Musk found.
That's right. That's right.
They could live to that long, and that income check will still be coming in forever. Even when account value is zero, it still comes in like clockwork.
Yeah.
And you can also plan for long-term care.
That's right.
That a lot of people might need. Was it 70% of us end up in a long-term care situation?
Yeah, exactly. So, and a lot of these have what they call an income doubler. So if you're making $100,000 a year from this payout and then
you go to long-term care, 200,000 right there.
Yep, exactly
right.
So here we are, Masters Week. It's my favorite week. I'll give you guys a little bit of a playbook here. If you're in your 30s, you're hustling out there, or if you're flexing your AARP card because was it 55 if that you get that?
Yeah.
For those 20 and 40s out there, stock up. I wouldn't say buy a particular AI because heck, I bought Palm Pilot when I was in my 30s because I thought this was the greatest technology in the world, and it was for a minute.
They were in the S&P 500.
Yeah. And all of a sudden, boom, they disappeared. They vanished. I'm like, what the heck? And I'm a trader, and I missed that one. I was like not paying attention to my own stuff.
Yeah.
So So there's things out there. Make sure you diversify your risk. I don't care how.
Don't go all in. Never go all in. I mean, even if it's a sure thing, don't go all in.
This blockchain thing, I think that's a real thing.
Cloud storage, probably.
But don't go, buy your cousin's crypto called the moon coin or anything like that. That doesn't count. I would recommend get some professional help. Again, I'm a professional on my own stuff because I wasn't paying attention. I should have hired it out to pay somebody to watch mine because I was watching everybody else's institutional side. I had a little chump change. I didn't really care about it. But, it'd been nice if I would have sold off of that because I was paying attention. When you're in doing whatever you're doing, it's best to take some of these things that you can't put the time in.
Right.
And as you start having babies and stuff, all of a sudden, that little 2-year-old takes up a lot of time, or the newborn, you're not sleeping.
Yeah, ever. Yeah.
So actually, when the Palm Pilot started crashing, I had 3 kids in diapers. So my world was crazy. My wife's world was even more crazy. So it kind of blew up by the time I saw it. I'm like, what the heck happened? My youngest was now 2, and the other 2 were finally out of diapers. So I got a chance. So that's real life, man. That really happens.
Yeah, stop trying to do it by yourself. Exactly. I did that for years. I managed my own investments for years, and in a bull market, it was pretty easy.
Yeah,
you almost couldn't lose, and I had a pretty sound strategy. But when that bear market came around, I wasn't sleeping.
Yeah,
I was analyzing stocks, and I'd spend all morning analyzing a stock and be like, all right, I'm going to go get it, and I'd go look and I'd miss my price point.
Right.
I'd already missed my trade,
right.
And I've just spent my whole morning researching a stock. I still never bought it. So you can't go it alone. You can get lucky here and there, but in the long run, it's like a casino.
Exactly.
I mean, it is legalized gambling, basically. You pay taxes on your winnings just like regular gambling. Yeah. But if you're going to go into a poker tournament, which is what you're doing when you're getting into a stock market, go be friends with a professional poker player.
Yeah,
he'll show you how to do it.
That's right.
And the professionals are the advisors out there. Find one that's been at it a while. Don't go with your neighbor's nephew that just got his degree and he just started at Charles Schwab. Don't go with anybody. Yeah,
that's right.
Don't go with somebody right off the block. Go get you somebody with experience, somebody with a track record, and somebody that is willing to put you into alternatives if your risk tolerance is not what it should be.
Yeah, you can hit on the comment in our Plan Life Right podcast. Just put help.
Yeah.
And we can reach out. We'll have one of our experts reach out, help you navigate the future if you're in towards that retirement phase. We've got people that specialize in that. Those 50, 60, 5 plus, if you've got, you should have still money in there as volatile as it's been. Take the win, maybe. Those wins you made from 2022. Do whatever. Do some of that now. What I would recommend, find an advisor who will do a financial retirement plan, who specializes in the decumulation phase of your life. A lot of these guys, they're really good because they got longevity and they think they're all of that. But then when it's retirement, they're like, wait a minute, I'm losing assets under management, and they don't solve for it correctly.
Right.
So make sure you find somebody that's their expertise. You need growth. You got to have growth, but you got to have that predictability. And then maybe you're able to buy a new golf bag or get a club fitting, because just like the sequence of return risk that I talk about, here's the other thing I can guarantee: as you get older, your golf swing slows down. So, for those at all ages, there's a lot of noise out there. Typically the financial media, it's 80% panic. It's 10% hype. It's 10% of the Jim Cramers out there. Just get a well thought out plan that assesses the risk tolerance, your risk tolerance, and then stick to that plan, because everybody has the highest risk tolerance, like you said, when the market's running and when it's volatile like this. That's the true measure of where you're really at on your risk tolerance. Stay diversified, and for heaven's sake, don't invest based on these TikTokers alone that are in their 20-somethings telling you that the 4% rule is the end all be all, because it ain't. They don't understand because they haven't lived it that there's a 40% fail rate. I haven't found one that talks about that. So that means you have to have a better than a 60% probability that one or both of your spouses, this is what I do know, are going to need long-term care assistance. That's a fact out there. So you got to be able to plan for it. Make sure that your advisor's talking about it. If he's not, find a new advisor.
Yeah. And hey, if the market dips again, just remember it's not a crisis, it's a clearance sale. Well, maybe.
Right.
Remember to like, follow, and subscribe to Plan Life Right and Advisor Rescue. And like Kevin said, drop a comment down there. Just says help.
Yeah.
We'll reach out to you. We'll get in touch with you. We'll find somebody that can guide you down the right path. If you want to learn more about the things that we said, if you're an advisor or a retail investor, just put a comment down there. We'll reach out to you. We'll explain it.
Right.
If you just heard for the first time, you can plan for college savings with life insurance. It's fascinating. If you want to hear about what is secrets of return risk, what is longevity risk, if your advisor hasn't mentioned those terms to you, and you are within 10 years of retirement, you need to find yourself a new advisor because he's a saver. He can show you how to build a mountain of cash, but he has no idea how to get you back down that. And there'll still be some mountain left at the end of your life there.
Yeah, well, I think that about wraps it up. Man, I got to say, this market podcast is every bit as exciting as the last few hours of a Masters Sunday.
That's right.
Like and follow.